everyone, this is Fei Yen from Keller Williams Realty. Welcome to Wealth Building Wednesday. Today I'm going to talk about how to build wealth through rental properties. Now, there are two ways to evaluate a rental property. First of all, number one is create cash flow, right? Number two is build equity through appreciation. Now, when we analyze the cash flow, we had to look at the expense, such as property tax, such as mortgage. Mortgage for investment properties is always higher. The rate for mortgage is always higher than homeowners' properties. And also look at the insurance payment. And also look at the other expenses. The tenant usually pay for their own utilities, but the landlord usually had to pay water, sewer, and trash collection, and sometimes HOA. And also you need to look at the property. Are you going to maintain the property, or are you going to hire a property manager to maintain it? Usually if you hire a property manager, it's 10% out of your rent, right? And other expenses such as pest control and lawn maintenance. And also you need to look at the vacancy rate, because sometimes your property will be sit on the market and it doesn't rent it out. Usually it's 5% we need to calculate into the vacancy rate. And also the maintenance, such as things need to be replaced, repaired, a property, sometimes you just have to fix that, right? So you need to allocate 10% of your money to do maintenance. And now, how do you do the cash analysis? You take the total rent minus the mortgage payment, minus landlord paid utilities, minus property management fee, minus maintenance allowances and vacancy allowances. Then you have a cash flow. Investors could also have other ways to evaluate rental property, such as cash on return, which you take the property annual cash flow divided by the purchase price. That purchase price could also include the closing costs, the improvement you made to the property, the legal fee, and other purchase expenses. For example, a property has an annual cash flow of $7,000. You buy it for $200,000, and then you convert, which is 3.5%. Now, 3.5% is not a great number, but it's better than the money you put it into the bank. You could also use the capitalization rate, or the cap rate, which you take the annual gross income minus all your expenses, and then you get net operating income. Then you use the net operating income divided by the total purchase price, which gives you the cap rate. For example, a property generates $9,000 income, and you minus $2,000 expenses, you have $7,000. Then you take the $7,000 divided by $100,000 you put it in to purchase it. Then your cap rate is 7%. 7% is pretty good cap rate, because a good cap rate on an investment property is between 4 to 12%. Some people also use the gross rent multiplier, which you use the monthly rental income divided by the purchase price. For example, the purchase price for this property is $100,000. Monthly rental income is $1,000. Then you take 1,000 divided by 100,000, which is give you 100, which is the rent multiplier. Now the $100, it's actually pretty large. You want this number to get as low as possible. If you could get up to like 20%, that would be great. Second way is to look at investment property is build equity by appreciation. You could look at the neighborhood, the growth rate, the property tax, the school, the crimes, and all the other stuff. It's actually very hard to project how much appreciation you're gonna get from a property. So it's always better to buy a property that you know you're gonna get cash flow, instead of trying to predict the future. And if you have more questions, you could always reach out to a local realtor, such as myself. And you can reach out to me at 646-491-0163. Thank you so much for watching. I'll talk to you next time. Bye-bye.